All right, let's talk about something that's got a lot of people in the market buzzing. Opendoor. You've probably heard the question, right? Is this the next Carvana? I mean, investors are piling in, betting it's going to follow that same wild, explosive growth path. But is that comparison actually, a good one? Or is it seriously flawed?
And look, on the surface, you can totally see why people think that. They're both tech companies shaking up old industries. The market is pricing Opendoor as if it's a sure thing, expecting that same incredible ride we saw with Carvana. But once you start to peel back the layers, you find some really fundamental differences. And these differences, well, they could change the entire story. So let's dive in and see what's really going on.
Okay, so here's how we're going to break this down. First, we'll tackle the big myth that's floating around out there. Then, we're going to dig into some of the hidden risks inside Opendoor's business, stuff you might not have thought about. After that, we'll put these two companies, Opendoor and Carvana, right next to each other and see how they really stack up. We'll also look at a critical difference in their profit models. And hopefully, by the end, you'll have a completely different perspective on Opendoor's path forward.
So let's start with the big question. Why is everyone so hyped up about this comparison in the first place? Well, it's a story the market just absolutely loves, right? You've got this slick tech company strolling into a massive, kind of clunky, old-school industry, real estate, and promising to turn everything upside down. It sounds exactly like the Carvana playbook, doesn't it? They did the same thing for the used car market, which, let's be honest, was a total headache before they came along.
And you can see this hype reflected in the stock price. The market is basically betting that when interest rates start to fall, it's going to be like pouring rocket fuel on Opendoor's business. But here's the thing. That core assumption that lower rates in a hot housing market are automatically a win for Opendoor is actually where the danger lies. It's not nearly that simple. And this is where things get really interesting. Because the one thing that everyone believes will be Opendoor's savior, those falling interest rates, could actually be its Achilles heel. It's a huge paradox, and the reason why is hidden deep inside the way their business actually works.
You see, a traditional real estate agent, they're just a matchmaker, right? They connect a buyer and a seller, take their commission, and they're out. They never own the house. But Opendoor's iBuying model is totally different. They use their tech to make you an instant offer, and then they buy your house directly. They hold it as inventory, then try to resell it. And that, right there, exposes them to a massive risk that regular brokers just don't have. The risk that home prices could fall while they're holding the property.
And this leads to a really wild paradox. Logically, you'd think a booming housing market would be amazing for Opendoor. More transactions, more business, but it could actually crush their bottom line. Think about it. Interest rates fall, and suddenly everyone wants to sell their house at the same time. What happens? The market gets flooded with supply. And basic economics tells you that when supply skyrockets, prices can drop. All of a sudden, Opendoor is sitting on a bunch of houses that are worth less than what they paid for them. Ouch.
Okay, so this whole inventory risk thing, this is one of the first major cracks you see in that shiny Opendoor is the next Carvana narrative. That might look similar from a distance, but when you get up close, you realize their businesses are built on completely different foundations. They're not twins, they're more like distant cousins who just happen to look a little alike.
Just look at this breakdown. Carvana came in and became the #1 undisputed king of online car sales. Opendoor? Well, they're #1 in this tiny little niche called iBuying. But the 800-pound gorilla in online real estate is still Zillow. And think about the models. Carvana didn't reinvent the wheel. They just made the wheel way better by digitizing the dealership model. Opendoor created a brand new, unproven model from scratch, and it comes loaded with all that risky inventory we were just discussing.
And this, right here, gets to the absolute heart of the matter. Carvana's big crisis, it was a financial problem. They took on way too much debt. That's serious, but it's something you can fix by restructuring your finances. Opendoor's problem is fundamental. It's about their core business model, which is super fragile in certain market conditions. When the housing market turns south, their business can just shrink. And that is a much harder problem to solve than just reshuffling your debt. But now, we get to what might be the single biggest, most decisive difference between these two companies. It's the one thing that truly separates their long-term potential. And it all comes down to where the real money is made: financing.
You know this playbook? It's a classic. Think about Amazon. Their online store is what gets you to their website. But Amazon Web Services, their cloud computing division, is a massive profit engine. It's the same idea here. Selling cars or houses is the main event that gets customers in the door. But the real moneymaker is supposed to be the high-margin financing you sell them on the back end. Here's the kicker, though. Carvana's model leads to a financing goldmine. Opendoor's, well, it just doesn't. And this is the whole ball game, right here. With auto loans, Carvana can basically charge whatever interest rate they can get away with. There's no real cap, which means their potential for profit is massive. But Opendoor is playing by a totally different set of rules. Mortgage rates are tied to government benchmarks, like the 30-year Treasury bond. That creates a natural, hard ceiling on how much profit they can squeeze out of each loan. Their upside is fundamentally limited.
That might sound like a small detail, but it's a profound limitation. Because of that ceiling, Opendoor simply cannot build the same kind of incredibly profitable financing machine that has fueled Carvana's growth. It's just not possible. They're playing in two completely different economic universes.
So after all this, what does it mean for Opendoor's future? Look, there's no doubt they're operating in a huge market with a ton of potential. But their path to success is going to look totally different from Carvana's. And frankly, it's going to be a lot more challenging in some really key ways.
So let's just recap what we've talked about. It's pretty clear Opendoor isn't just a copy-paste of the Carvana story. First, it has this unique risk tied to the value of its housing inventory. Second, it's not the dominant player in its overall market like Carvana is. And maybe, most importantly, its profit engine, the financing side, is seriously capped in a way that Carvana's just isn't.
So what's the big takeaway here? It's that the simple comparison you hear everywhere is, well, it's kind of a trap. It's misleading. Carvana's already been through its big crisis, that debt problem, and now its path forward is much clearer. Opendoor, on the other hand, still has to answer the most fundamental question of all. Is our core business model actually sustainable through the ups and downs of the housing cycle? They are on two totally different journeys.
So yeah, the Carvana comparison is pretty flawed, but that leaves us with the real question about Opendoor. The goal for them shouldn't be to become the next Carvana. It has to be about becoming the first Opendoor. Can this company overcome all these unique hurdles we've discussed? Can it solve the fundamental challenges baked into its model and carve out its own unique path to success in this gigantic real estate market? Now that is the real story we should all be watching.